Okay, let's unpack this. Welcome back to the deep dive. Our mission today is very specific. We are going to be doing an in-depth dissection of CubeSmart, ticker symbol CUBE. It's the third largest self-storage REIT. And we're framing this for the highly critical, experienced investor, so we're skipping the fluff and going straight to the core questions of value right now in late 2025.
Exactly. And the context here really demands a rigid financial framework. I mean, we have to move past the headlines and assess three fundamental pillars.
Okay, what are they?
First, does CUBE actually have a demonstrable, durable competitive advantage? A real moat? I mean, we're talking about an industry that sells a pretty undifferentiated product.
Corrugated steel boxes, right?
Precisely. Second, is their capital allocation disciplined? And third, this is the acid test. At the current valuation, does their strategy, their focus on these high-barrier urban markets, actually generate a sufficient return on invested capital?
The ROIC spread.
That crucial ROIC spread over their weighted average cost of capital, the WACC. Because if that spread is negative, the whole investment thesis is, it's fundamentally flawed until proven otherwise.
Right. And the timing here is just so important because the sector is in a transition. We're well past that frenetic post-pandemic demand surge and the price normalization that followed. Late 2025 feels like we're entering a new cycle. It's defined by stabilizing demand, not accelerating, but stabilizing. And maybe more importantly, a moderating of new supply. This is where the quality should really start to stand out.
It is. Let's just look at the Q3 2025 snapshot to set the stage. The market's initial reaction was, a bit negative because CUBE reported a slight miss on EPS.
Earnings per share, right.
Came in at 36 cents versus a 38-cent consensus. But for the kind of sophisticated investor you're talking about, that EPS miss is basically noise.
Okay, explain that. Why is the EPS miss noise compared to, say, the FFO print?
Well, it really just comes down to accounting versus actual cash generation. EPS gets hit by all these non-cash charges, depreciation, amortization, and the complex accounting adjustments from their JVs and recent acquisitions.
Okay.
Funds from operations, FFO, that's the real indicator of operational resilience for a REIT. And CE delivered FFO of 65 cents per share.
Which was right on target.
Exactly. It shows the underlying cash machine is working just fine despite the market pressures. The miss was an accounting entry, not a cash flow failure.
Got it. But the core of that resilience, it seems to be tied to one very specific data point, one that suggests a real fundamental shift has happened.
That is the pivotal piece of information.
Yep.
I mean, if you're an investor looking for an inflection point, this is it. For the first time since the first quarter of 2022, CQB reported that their move-in rates turned positive.
And by how much?
Clocked in at plus 2.5% year-over-year growth in Q3.
That 2.5%, it's not just a number, is it? It feels like a definitive signal. It's saying that the pricing wars, that race to the bottom where everyone was just slashing rates to keep occupancy up.
That's over.
That war is finally over. That 2.5% says the industry is healing. It suggests the bottom in pricing has formed, and that's a huge tailwind for 2026.
It's everything. Without a floor on street rates, all the other stuff, ECRIs, expense control, acquisition yields, it's all moot. This single green shoot is what separates today from the struggles of 2023 and early 2024.
Okay, so with the environment set, let's dive into that core thesis, the competitive advantage. We know the product is basically a commodity. So for a smart investor, the moat has to be structural. And CQE's whole pitch is this urban fortress idea. Let's put that fortress under the microscope.
It is demonstrably structural, but you have to look beyond the building itself. It's really just the old cliche, location,
Right.
location, location. Specifically, high-density, high-barrier-to-entry urban market.
New York City.
Exactly. CUBE has successfully become the market leader in the New York City metro area, focusing on the outer boroughs, the Bronx, Brooklyn, and Queens. These are areas with just extreme population density, insane land costs, and, a nightmare of permitting complexity.
And that density is key, obviously. Urban dwellers don't have garages or basements. But the real moat in New York isn't just the density, it's regulatory, right? This is where it gets interesting because it's a government-created advantage.
Precisely. The whole structural advantage hinges on the repeal of the Industrial and Commercial Abatement Program, the ICCAT tax incentives.
Okay, break that down for us. What was ICP?
So to get the moat, you have to understand the history. ICP was designed to encourage commercial development in parts of New York. And for years, developers used those tax breaks to make self-storage projects pencil out, despite the crazy high land and construction costs. But the critical move was that New York City repealed those incentives specifically for self-storage development. It was a direct policy strike. And boom, the underwriting model for any new builder just completely flipped.
So no more tax breaks.
No more. Without that decade-plus tax abatement, the all-in yield you'd need to justify new construction in a place like Brooklyn, it just doesn't exist anymore, not with current financing rates. So that action, it basically erected a permanent regulatory wall, protecting existing cash flows from the #1 threat in this industry, supply dilution.
So it's basically a government-sanctioned oligopoly in their key market. That's an advantage you can't just replicate with better tech.
You can't.
So how do we see that in the Q3 data? I mean, if the sector was still soft overall, does this moat actually translate into better numbers?
It's a conclusive validation. You see this clear bifurcation in performance. While a lot of CUB's peers were, heavily exposed to Sunbelt markets, Phoenix, Dallas, places getting hammered by unabsorbed supply.
Right.
CUB's specific NYSE borough portfolio, Bronx, Brooklyn, Queens, recorded a staggering 7.4% year-over-year rental increase in Q3.
Wow, 7.4. That's a huge outperformance, especially when the company's overall same-store NOI was negative.
It is. It's definitive proof the barrier is working. That part of the portfolio is essentially delinked from the broader U.S. supply cycle. When you see 7.4% growth in New York, while, suburban New Jersey is logging declines, the urban density thesis moves from just a theory to a verifiable fact.
So their best assets are shielded.
Exactly. Shielded from the broader shocks. That's what makes them such valuable compounders once demand picks back up.
Okay. Beyond the location moat, management loves to talk about their sophisticated revenue management and digital scale. To a critical investor, that can sound a bit like marketing fluff. How much of a real differentiator is tech in 2025?
It's rapidly becoming just table stakes. We have to be clear here. Every major REIT extra space, public storage, they all use advanced algorithmic pricing models.
Right. Everyone's got the software.
They're all dynamically adjusting street rates based on dozens of variables. So the competitive edge isn't in having the tech anymore. It's in the sophisticated application of it and the capital strategy that data allows.
So if the software is basically the same, where is CUBE executing better?
It's in their marketing spend. It's very differentiated, kind of counter-cyclical. The storage business is super seasonal. Peak demand is Q2, Q3 when people are moving. Q1 is the dead zone.
Makes sense.
So instead of just, a flat marketing budget all year, the brute force approach, CUBE's data, lets them intentionally save budget in Q1 and then deploy it heavily during those peak leasing seasons.
So they're spending when the customers are actually looking.
It's a shrewd capital efficiency move. They're optimizing for a customer acquisition elasticity. They know $1 spent in July gives them a way better return than $1 in January. And the results prove it. Q3 marketing expense was up 10% year to date, but that calculated spend led to a massive 26% jump in web sales traffic.
Okay, so they're getting more bang for their buck.
They're squeezing superior execution out of what's become a commoditized technology.
All right, we've established a pretty compelling qualitative moat location, regulation, smart marketing. But like we said at the top, a moat only matters if it creates superior financial returns. Here's where it gets really interesting and maybe a little contentious. Let's look at that financial asset test, the ROIC versus WACC spread.
And this is the central tension in the whole CUBE investment thesis right now. As of late 2025, CubeSmart's return on invested capital is sitting at about 7.5%.
Okay. And the WACC?
That is currently below our estimated weighted average cost of capital, which we calculate in the range of 8.6 to 8.9%.
So that's a negative spread of over 100 basis points. For a critical investor, that suggests value is being destroyed, or at best, it's neutral. So why should we believe this is just temporary? What's the specific milestone that proves this turns positive in 2026?
That skepticism is absolutely warranted. And the interpretation really requires you to look at the WACC denominator. The negative spread is largely a factor of the high interest rate environment, so higher for longer thing, and the timing of their recent acquisitions.
Okay, go on.
So let's just break down the WACC. In 2025, the risk-free rate, the 10-year Treasury is around 4 to 4.5%. CQE's cost of debt is up, as we saw with their recent 5.125% bond issuance. Add in the cost of equity, and you get to that high 8% range for WACC pretty easily.
Right.
Now, look at the ROIC. That 7.5% figure includes assets they just bought, the Storage West portfolio, and the HVP IV buyout. These assets were bought based on stabilized cap rate assumptions.
So they're not at full earning power yet.
Not even close. They
Yeah.
take 12 to 24 months to fully ramp up. Right now, they're dragging down the ROIC numerator while the full acquisition cost is sitting in the denominator.
So the argument is that this 7.5% is a depressed trailing figure, and the true marginal ROIC on these assets, once they're stabilized, should be well above 9%, which would flip the spread positive.
Precisely. We need to watch two things in 2026. A, we need to see stabilization reports on those HVP IV assets showing they're hitting those 5.5% to 6% yield targets. And B, we need to see them refinance upcoming debt at better rates. The proof is on management to show their urban assets can clear 9% WACC.
Okay, let's drill down into that Q3 same-store performance. The headline number was a decline in net operating income of 1.5% year over year. But the real story is in the expense line.
Yeah, the revenue decline was only 1%, which reflects that pricing pressure from early in the year. But the operational discipline on expenses is where CUBC is just in a different league.
Yeah.
You look at the Q3 data, CUBE held its expense increase to a shocking plus 0.3%.
That's nearly flat. And you compare that to a big competitor like Extra Space, their expenses were up, 6%? That is a massive divergence. How is that even possible?
It's a testament to their operational sophistication. There are really three key things going on. The first is just, generalized efficiency managing utilities, maintenance contracts, all that.
Okay, standard stuff.
The second, and this is the biggest factor, is successful property tax appeals. Property taxes are usually the largest single operating expense, and cash-strapped cities are jacking up assessments on commercial real estate. CUBE has a very specialized, proactive internal team that does nothing but challenge these assessments.
So that's a real investment in resources. It's not just filling out a form.
Oh no, it's a dedicated multi-year process. It involves sophisticated appraisal work, data, sometimes litigation. The benefit in a quarter like Q3 might be a one-time catch-up from a successful appeal, but the skill in getting that result is a permanent operational advantage. And the third factor is lower insurance costs. This is partly just their geographic footprint. They have less exposure to the catastrophic weather hurricanes, floods that plagues peers with huge Sunbelt or coastal footprints, which is where insurance rates are just exploding.
Okay, let's address the elephant in the room on ops metrics. Occupancy. CUBE's ending occupancy was 89%. That is way lower than its big peers. EXR is at, 93.7? PSA is over 94. That 4 to 5% gap looks like money left on the table.
I believe it's a calculated gamble on rate, not a failure to retain customers. In this business, you have to choose a strategy. You either prioritize rate, pushing rents, or you prioritize volume, keeping the building full. CUBE seems to be consciously leaving those last few points of occupancy on the table by refusing to drop prices to fill the last few units.
Why would they do that?
It's underpinned by the economics of the business. The gross margin is huge, around 72%, and the hassle cost for a customer is really high.
Nobody wants to move their stuff.
Nobody. It's a pain. So that inertia leads to very low monthly churn, like 4 or 5%. That stickiness means CUBE can aggressively push existing customer rate increases, or ECRIs, knowing the customer is unlikely to leave, even if the new rate is a bit above market.
So the thinking is hitting 94% occupancy would mean they'd have to sacrifice those high street rates and dilute the ECRI base. But by staying at 89%, they can keep rates firm and milk the existing customer base for margin.
Exactly. It's about revenue quality and margin integrity, not just pure utilization. It's a strategic choice, but it's one you have to monitor. If that gap widens, it becomes a problem.
All right, let's shift from operations to strategy. For a critical investor, how management allocates capital is maybe the best predictor of long-term returns. How disciplined has CUBE been?
Their track record shows a high degree of capital allocation IQ. It's really centered on risk mitigation, primarily through their joint venture model. We need to talk about the philosophy of the Heitman Venture Portfolio Series, the HVP. It's basically a sophisticated try before you buy strategy.
Okay, explain that.
In a traditional development, the REIT takes on 100% of the financial risk during construction and the initial lease-up, which is, the riskiest part. CQB flips that. They partner with an institutional fund like Heitman, and they only take a small minority stake, like 10 to 20%, in these HVP projects.
So they're offloading most of that initial risk.
Precisely. And they earn high management fees during that risky lease-up phase, which is great capital-light income. But crucially, they keep an option, a right of first refusal to buy the other 80 to 90% once the asset is fully stabilized.
So it protects the balance sheet. They only buy proven assets.
Exactly. And that HVP-IV portfolio acquisition in 2025 was the culmination of that exact strategy.
Right. They bought the remaining 80%.
They did, for $452.8 million.
Yep.
And because CUBE had already been managing those 28 properties for years, they had all the granular data. They knew the lease-up timelines, the cost structures. It meant they eliminated almost all integration risk. This wasn't a blind bet. It was an informed execution on a pre-vetted pipeline.
That said, let's put on the skeptical investor hat again. We're in a high-rate world. What about the yield on that $452 million deal? Was it actually accretive?
The yield was thin. That's the most critical critique. Management was targeting stabilization yields, the cap rate in the mid to high 5% range. When the 10-year Treasury is at 4 to 4.5%, that 100 to 150 basis point spread is very tight.
So this wasn't an immediate cash flow bonanza.
No, absolutely not. The motivation was strategic control over what they see as irreplaceable assets, not an immediate cash yield. They saw these 28 high-quality assets, many in those protected urban markets, as future compounders. They were willing to accept a thin near-term spread to get long-term control. It fits their whole growth at a reasonable price philosophy.
Speaking of prudence, let's touch on the balance sheet.
A fortress balance sheet. It's a strategic asset that lets them be opportunistic when competitors can't. Their net debt to EBITDA is at a very conservative 4.7 times. That's comfortably below the 5.5 times threshold for their BBB credit rating.
And they did a big debt deal in 2025. How'd that go?
They executed well, considering the environment. They issued $450 million of 10-year unsecured notes at 5.125% in August. Locking in 10-year debt at just over 5% during that period of rate uncertainty was a solid move. It terms out their floating rate exposure, which insulates FFO from more short-term rate hikes.
But that new debt is still more expensive than the old debt that's rolling off.
It is. That's the primary financial headwind. It's unavoidable. But CUBE mitigated the risk by locking in the term. And it just reinforces their philosophy. Disciplined timing, prioritizing stability over aggressive leverage. You can even see it in their management compensation, which is heavily tied to FFO per share and relative total shareholder return, discouraging that kind of debt-fueled empire building.
One last thing on management quality. Any signs of genuine candor?
They actually had a rare moment of humility that I think boosted their credibility. In their Q4 2024 commentary, they openly admitted that their prior forecasts about the housing market thawing were overly optimistic.
That's rare.
It is. That willingness to admit an error and manage based on the data you're seeing, not the story you want to tell, is a powerful signal of high-quality governance.
Okay, let's shift focus to the future. FFO growth was negative 3% in Q3. A defensive moat is great for preservation, but CUBE needs to get back to being a compounder. Where are the growth drivers coming from?
The return to compounding really relies on two things coming together: an inflection in their internal pricing power and a massive external tailwind from supply slowing down. This is where that strategic location really starts to pay off.
Okay, so let's start with the organic catalyst. We flagged that plus 2.5% move-in rate growth. Why is that the key to unlocking future FFO growth?
Because it's the first sign that street rate acceleration is now possible. When operators stop fighting on price, the average street rate stabilizes and then it can start to move up. Once that 2.5% move-in rate starts heading toward 4 or 5%, which they need to offset inflation, it flows right to NOI. And higher street rates set a higher base for future ECRIs, which is the high-margin engine of the business.
So that's the first domino.
It is, and it's being supported by that external driver. The supply deceleration, the cost to finance and build new storage has just completely crushed the economics of new development.
Give us the numbers on that. How bad is the national supply picture?
Nationally, the combination of high debt costs and astronomical construction costs caused new construction starts to contract by about 20% in 2024, and that has continued through 2025. The math is just unforgiving. When your cost of construction financing is maybe 8 or 9% and the best yield you can underwrite is in high fives, the project doesn't make sense.
So the financing tap has been turned off.
Completely. And that creates a multi-year gap in new supply that will hit the market starting late 2026 and into 2027.
And this supply story is even more extreme in CUBE's core urban markets, right? The moat acts as a force multiplier here.
It's absolutely intensified. The regulatory and cost barriers mean the impact of high rates is magnified. New supply forecasted for CEB's core urban markets is expected to drop by 15% in 2025, and then an even steeper 18% in 2026. This creates a true supply vacuum right where CEBE has its most protected assets.
So when demand comes back,
The moment consumer moving trends normalize, when the housing market finally thaws, CUBE will face basically zero new competition in its most important markets. That structural scarcity is what gives them this embedded call option on sector-leading NOI growth.
okay, that's the organic side. What about external growth, the third-party management platform? How important is that for an investor looking for capital-light growth?
It is a vital, high-margin buffer. It's a fee-based business, so it insulates CUBE from the cap rate volatility that affects their own portfolio. They added 46 stores in Q3 alone, bringing their total managed stores to 863.
Wow, 863. What does that generate?
The platform is projected to generate between $42 and $44 million in fee income for 2025. That's high-margin income that flows almost directly to FFO. But more importantly, it gives them huge operational leverage. They can spread their tech backbone, the algorithmic pricing, the call center, the marketing over a much wider asset base. And it acts as a proprietary acquisition pipeline. They manage the stores, get years of detailed operating data, and then they can cherry-pick the best ones, just like they did with HGPIV. They get the data before they take the risk.
So given all that, what's a realistic path back to FFO compounding in 2026?
I think the base case is low single-digit FFO growth for 2026, maybe 2–4%. That assumes the current move-in rates accelerate a bit and the 2025 ECRIs fully earn in.
And the path to high single-digit growth?
That really depends on macro factors. You'd need a substantial drop in interest rates, which would lower their WACC and make acquisitions accretive again, or a big rapid surge in housing market activity. Until one of those happens, compounding will be moderate.
Okay, before we reach a verdict, we have to rigorously assess the downside. Let's talk specific risks that could compromise this urban fortress thesis.
All right, on the business side, the biggest one is regulatory reversal in New York City. The entire IC cap moat is a legislative creation. If the city government, maybe under pressure to spur construction or raise tax revenue, decided to reverse that policy and bring back incentives for self-storage,
The moat would just evaporate.
it would erode very quickly.
Yeah.
That would open the door to a new supply cycle and just crush their pricing power. It's a political risk, not an operational one.
What's the second business risk?
Tax sensitivity. We praise them for that 0.3% expense growth, but a lot of that came from successful tax appeals, which are non-recurring. If these cash-strapped cities decide to systematically target commercial landlords like CUBE with aggressive assessments, you could see severe margin compression and quickly.
And what about financial risks from the macro environment?
The primary one is still refinancing risk. Even with their low leverage, they have to keep rolling over old, cheap debt with new, more expensive debt, like those 5.125% notes. That higher interest expense is a structural headwind to FFO growth.
And the second financial risk.
Valuation compression. If this higher-for-longer world persists and the 10-year Treasury yield moves above 5%, private market cap rates will expand further. And if that happens, the underlying net asset value, the NAV of CQB's portfolio, could decline. That would erode the margin of safety that the asset value currently provides for the stock price.
Okay, let's triangulate the valuation. Where does it stand now? Is the stock priced for this risk profile?
So based on their 2025 FFO guidance of around $2.58, and with the stock trading in the $37 to $39 range, CUBE is trading at a PFFO multiple of roughly 14.5 to 15.1 times.
And that's a big discount, historically speaking, right?
It's a profound discount. I mean, historically, in normal times, CUBE commanded a multiple between 18 and 20 times FFO. The market is clearly punishing them for the current negative same-store NOI, the high cost of capital, and the uncertainty around that ROIC/WACC spread. This multiple prices in all the bad news and very little of the upside. And now for the really critical NAV assessment, private market cap rates for high-quality, supply-constrained assets like these are stabilizing in the high 5 to low 6% range. But the current stock price implies the market is valuing the portfolio at a cap rate in the mid to high 6s.
So the public market is valuing the assets at a higher, more distressed cap rate than private buyers are.
Exactly, which indicates the stock is trading at a palpable discount to the private market value of its underlying assets. That NAV discount is the critical margin of safety for an investor. You're buying the assets for less than they're worth, getting paid a nice yield to wait, and hoping the market multiple eventually catches up to reality.
Okay, summarize the bull case catalyst for us one last time.
The bull case is all about realizing that structural scarcity. If the NYSE supply constraints drive 5+% rent growth in their core portfolio, and that happens at the same time the housing market thaws, FFO growth could accelerate to 6 or 7% annually. That growth, plus the stock re-rating back to its historical 20 times multiple, delivers a very attractive total return.
So what's the final investment verdict on CubeSmart?
The verdict is that CUBE is a high-quality defensive business trading at a cyclical discount. Despite that temporary negative ROIC-WACE spread, the core moat and the disciplined capital allocation remain fundamentally intact. That Q3 positive move-in rate is the key green shoot at the bottom is forming. And at 15 times FFO for Class A urban assets, the price is just highly reasonable. It provides a real margin of safety through both asset value and that attractive sustainable income yield of over 5.5%. To summarize for the long-term, patient investor, CubeSmart's ability to control expenses and the outperformance of its high-barrier urban assets, that's a testament to skill, not luck. Despite the current trough in FFO growth, the stock offers a compelling blend of resilient income and long-term capital preservation. It's positioned exceptionally well for the next real estate cycle.
So what does this all mean for you, the disciplined investor? We've seen the inflection in pricing power, and we have the hard data showing that new construction supply is collapsing, especially in CUBE's most profitable, protected New York markets. The critical question to ponder, the final piece of the puzzle, is this. Given that sharp deceleration in new construction forecasted for 2026 and 2027, does the market currently underprice the embedded call option on sector-leading NOI growth that will inevitably materialize once the frozen housing market finally thaws? That potential re-rating seems too cheap to ignore, and perhaps the biggest opportunity lies in waiting for that inevitable thaw.